What is going on, guys, and welcome back to another very exciting video. In this video, we're going to be talking about a company that I personally do not own, but I have looked to add to the portfolio a number of times in recent years, and that is Disney. Disney has a very interesting business model that has made a transition in the last few years ever since the pandemic. They have really started to focus on their online business, their streaming services, and that has been a huge factor for where Disney's stock price has headed over recent time. So what we're going to do in this video is we're going to take a look at first their valuation. Where has the value of the company gone over recent history, and where could it be headed in the future? Then we're going to take a look at their most recent earnings report. They have some interesting numbers in terms of their EPS as well as their subscriber count. So we're going to look at both of those. Then we will leave off the video by taking a look at all of their key metrics. That is their revenue, that is their EPS. We're going to look at stock-based compensation, and then we will also look at shares outstanding. So we are going to go over everything that you need to know about Disney in this video. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at their chart. We can see here today, they moved up around 2.5%, the same over 5 days. If we look at the last month, we can see that they are down exactly 10%. If we look at the last 6 months, they've traded a little more sideways, down only 5.25%. Year to date, only up around 2%. And if we look at the last year, they are down 16.5%. The most interesting chart, in my opinion, is their 5-year chart, because here is where we have gone through the biggest transition. So we can see leading up to the pandemic, the stock price was trading at levels around $140 to $150. And then we had obviously the global pandemic hit and the stock plummeted all the way down into the 80s. And from there, the business really changed how they were really approaching their content. They started moving to a Disney Plus, Hulu Plus, ESPN Plus type of platform. And that obviously worked out very well in terms of what was going on over the pandemic. A lot of companies, however, had similar run-ups. They had a lot of hype around this online type of business platform. And however, in the last year or so, we have seen the company fall off in a very significant way. We can see from these all-time highs of around $200 to where we are sitting at now, the stock is down over 50%. Before we get into all the metrics, I think it's important to note some of the short-term issues that are going on with Disney, specifically the Florida government and their issues with Disney World. The 30-second breakdown of this situation is that back in 1967, Disney World was granted special tax status. This allowed them to make their own decisions on planning and permitting for construction, also to levy taxes to pay for their own fire and medical response services, and even generate some of their own electricity. Through this status, the company has been able to save millions of dollars annually on fees and taxes. So in 2022, this special tax status for Disney World was actually removed. However, it was soon found out that taxpayers in counties nearby would have to foot the bill for the services like fire protection, policing, and road maintenance that Disney World was covering within the district. It was also found out that this district was carrying roughly $1 billion in bond debt, and if the district was abolished, this debt would be transferred to nearby counties. So to avoid all of these implications on nearby counties, the Florida legislature actually reinstated the tax status for Disney World. However, obviously, there's a lot of back and forth still with Disney World because of the bad blood over this situation. So with all that said, let's go ahead and jump into some of the metrics behind the business. And let's start off by taking a look at their valuation. And forward P/E ratio, in my opinion, is the best determinant of valuation. We can see that they are currently trading at a 23.04 forward P/E ratio. However, over the last year, they've traded all the way down to a 17 and all the way up to a 32. One thing to keep in mind is how market cap has also changed over that time period. We can see back in the June to September timeframe of last year, they were trading around a market cap of $170 billion. Here today, they're also trading around a market cap of $170 billion. What this tells us is that analysts back in this June to September timeframe were projecting that earnings over the next year would be fairly positive. However, earnings estimates compared to where they are at now have clearly come down in a fairly significant way. We can see that the PE ratio over that time period has increased by 7 points. That means that analysts have basically brought down their projections on EPS over the next year. And we can even see that downtrend represented here on Yahoo Finance. We have current year estimates of $3.92 in EPS. However, 3 months ago, analysts were projecting $4.15 in EPS. And overall for the current year, we have analysts sitting at an average estimate of $3.92. There's a low estimate of $3.29 and a high estimate for EPS of $4.18. So what we can do with those numbers is we can take them and run our own forward PE ratio numbers. So what that means is we are taking the current price of $90.70 and we are dividing it by each of these expectations for analysts. So the first one being the average expectation of $3.92. We are currently sitting at a forward P ratio of 23.14. For the low expectation of $3.29, we are currently sitting at a forward P of 27.57. And for the high expectations around EPS of $4.18, we are currently sitting at a forward P of 21.70. So in my opinion, anything above a 20 forward P ratio is relatively high for a company like Disney. What we saw before the pandemic is Disney trading anywhere from a 12 to a 20 P ratio. And in my opinion, that's more of a fair valuation. I think a 15 to a 20 is a fair value. I think a 10 to a 15 is probably slightly undervalued. And anything below a 10 is an extreme undervaluation of Disney's business model. So right now, I think it's kind of trading on the higher side of that range. It's sitting right at that 20-point range. And I think part of that has to do with the growth and the shift of their business model. I think with them shifting to more of this online streaming service, I think they've kind of commanded a little bit higher of a valuation, but still, in my opinion, I'd love to see them trade down if I were to add a position into Disney. One thing to keep in mind is Disney used to be a big player in terms of their dividend. However, in 2020, with the pandemic rolling through, they cut that dividend. And I think that was important at the time. With the shutting down of all of their theme parks, I think that cash flow was really needed to keep close to home and also to help them build out their streaming business. This really speaks to how Disney has transitioned over the last couple of years, because they went from a very dividend-based investment group to now really having a lot more growth investors invested in the business. And I think that speaks also to their valuation. They've kind of commanded a higher valuation because they've really been focusing on growing this other sector of their business, being the streaming service. So let's go ahead and jump into Disney's most recent earnings announcement. In terms of revenue, we see some solid growth numbers. We see that over the quarter and the 6-month period, they grew 13 and 10% respectively. In terms of diluted earnings per share from continuous operations, which is the closest metric to GAAP earnings, they came in at 69 cents for the quarter, which is up from 26 cents from a year prior. The number that actually gets reported out is this next one, which is excluding certain items. Those items are specifically amortization as well as some impairment charges, and that number actually decreased year over year to 93 cents from $1.08. So here we can actually see those numbers represented graphically. One thing to note is we can see down here that the most recent quarter, they have 69 cents in earnings. What that means is these are actually their GAAP earnings. So that is just one important thing to note. However, what's more important in my opinion is the trend, seeing how these numbers have trended over time. So we can look back to 2018, 2019, and we could see that they had some amazing quarters where they were reporting around $3.55 in earnings for the quarter, and their trailing 12-month earnings was sitting around $9. However, with the pandemic hitting, we saw their business drop off in a major way. We can see a quarter here of around minus $2.61, which is very significant. And Disney is a business model that you would expect to be hurt in a significant way from a one-time pandemic like that has a lot of theme parks that are going to have to be shut down, potentially laying off of employees, things like that. However, it's important to note that we have kind of seen the numbers trend back up in a positive way. We can see here, again, we're sitting around 70 cents in EPS per quarter. And when we compare this to around a couple years ago, back in 2018, 2019, we were sitting around numbers of, anywhere from $1.50 to $2 in EPS. So we are still significantly below those numbers. And here we have those revenue numbers that we spoke about earlier. So last year, they reported around $19.25 billion in revenue. Here this quarter, they reported around $21.81 billion in revenue, which is a 13% change year over year. And here we can see how those numbers have changed graphically over time. Again, the most recent quarter is sitting at $21.81 billion in revenue. What I like to look at is the trailing 12-month revenue numbers. So we're sitting at $86.98 billion in total revenue. When we look back to their highs before the pandemic, they were sitting around $78.28 billion in revenue. And then obviously we saw that drop off throughout the year as the pandemic kind of raged on and they had to close down a lot of their theme parks. However, they've really bounced back in a very positive way over the last couple of years and gotten to new all-time highs in terms of their revenue. The biggest issue is the sector that they have transitioned into. So they've transitioned from a theme park sector where they were licensing a lot of their content to now a sector of the business that is really competitive. With the streaming services, there are obviously a number of players in that industry that are all competing to have subscribers and really gain subscribers. So what we have here is where their numbers came in terms of subscribers over the last quarter. So we can see that their total Disney Plus subscribers are sitting at 157.8 million million subscribers compared to the quarter before where they were sitting at 161.8 million subscribers. This is down 2% quarter over quarter. ESPN Plus has seen 2% growth. They were sitting last quarter at 24.9 million subscribers, and they are up to 25.3 million subscribers this quarter. So obviously seeing a 2% decline in subscriber count quarter over quarter is never a good thing. However, I think this is probably just a transition from winter months to summer months where people are spending more time outside and they are probably thus canceling their subscription. However, one thing we are seeing from the streaming service industry that is very important moving forward is that they are really focusing on growing their revenue per subscriber. And we have seen that from Disney Plus. Disney Plus went from last quarter $5.95 in revenue per subscriber all the way up to $7.14. This is 20% growth quarter over quarter. And that is important to note. That is something that is happening across the industry in general in terms of streaming services. We've seen it from Netflix, where they're really focusing on cracking down on password sharing and trying to get their subscriber count up as well as their revenue per user up. And that is ultimately going to lead to this industry growing their revenue numbers and growing their profitability. As Disney has gone through this transition in their business model, they've also had to attract a lot of talent. And one way they have approached that is by offering more stock-based compensation. We could see really before the transition, they were sitting around $0.4 billion in stock-based comp on an annual basis. In 2019, we saw that number jump all the way up to $0.7 billion. And then in 2020, down to 0.5, in 2021, up to 0.6. And then in 2022, we saw a massive growth in their stock-based compensation all the way up to $1 billion. And we could see that stock-based compensation has really diluted existing shareholders. Back in 2018, they were sitting around 1.5 billion shares outstanding. However, they saw around a 20% jump in that number to 1.8 billion shares outstanding as they've had to offer a lot of this stock-based compensation to really attract a lot of this talent. One thing they were doing really well before this is decreasing their shares outstanding by offering buybacks. And I think eventually they will get back to that. However, in the short term, they've wanted to attract a lot of talent, really build out this side of their business. And part of that has been this stock-based compensation that they've had to offer. With the numbers we've gone over, you'd really expect their free cash flow numbers to be hurt in a significant way. And that is consistent with what we are seeing. So back in 2018, they had around $10 billion in free cash flow. And we can see here in 2022, they had around $1 billion in free cash flow. So overall, I think they will get back to a lot of growth in their free cash flow numbers. We have seen that specifically from Netflix. They have focused a lot on growing their free cash flow over the last couple of quarters. And that has really helped investors gain confidence in Netflix's business model. And I think ultimately Disney Plus will get back to that. I think Disney as a whole is going to get back to a lot of growth in their free cash flow. I think they're still just playing catch up to where Netflix is at because Netflix was so far ahead of the game in terms of the streaming industry. So personally, I am not buying Disney right now. I think they're still going through this kind of transition into the streaming industry, and I want to see where they would work out over the next couple of years. I do think there are a lot of positives with the business. The fact that they have grown their revenue consistently in a very significant way and are sitting at all-time highs in terms of revenue numbers, I think that is a positive. I think their EPS numbers getting back on track, I think that is a positive. I think we'll start to see those grow in a more significant way, and that's going to have a big impact on the business. I also think their free cash flow is going to get back to growth again because we've seen that from Netflix and their business model. In my opinion, I do think Disney is going to be one of the top 3 players in the streaming industry. I think they are right now, and I think they'll consistently kind of hold that. And I think they could be relatively competitive with Netflix. If anyone can really compete with Netflix and produce their own original content, I would have faith that that would be Disney. So that is all my opinion though. Keep that in mind. Again, I do not own this company. I do not plan on buying it in the near future just because I think there are better deals out there in the market. But always keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research, finding companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.